Stock markets are coming under a bit of pressure again on Thursday after Jerome Powell disappointed markets on Wednesday evening, talking about the outlook for the US economy, the global economy really as a whole, offering quite a grim outlook, calling for more fiscal stimulus from the government, and also removing the possibility, at least in the near term, of negative interest rates in the US. Now, I think there's a few things to touch on in respect to all of this. One, with respect to the fiscal policy side of things, we know that the Democrats, of course, in the House put across another $3 trillion bill that was quickly rubbished by Republicans in the House as well as the White House itself. So clearly we're not in any way close to any more fiscal stimulus as far as the US is concerned, despite these shouts from Jerome Powell, but also others as well, in respect to the need for more stimulus throughout the global economy in order to get us through this extremely troubling period. The negative interest rates component I find most interesting because ultimately, even if the Fed does go into negative interest rates, it's likely to be very cautious in doing so. The Fed, like the Bank of England, has repeatedly stressed the potential risks to financial stability caused by going into negative territory. So you have to question just what kind of an impact negative interest rates positively could have in terms of the economy, but also the markets. I'm sure both central banks have other tools available which would be far more promising, but also far less risky at the same time. But it does just remind us that these are markets that are hooked on stimulus, and not just hooked on stimulus. We've got unprecedented record amounts of stimulus, but they are hooked on more and more. And especially at this uncertain time, it's clear that the risk of central banks now withdrawing stimulus or even just maintaining stimulus as it is, as well as governments around the world, may be enough to derail markets. Investors just continue to demand more. Of course, these are just short-term moves, so we'll continue to watch how this develops over the coming days and weeks. But these early remarks, these early warning signs are potentially a little bit worrying for markets, which have already rebounded very aggressively when you consider the economic outlook, which we are potentially or certainly facing, with the UK, for example, on course for a very, very severe recession, potentially 35% contraction. The US as well and others also facing a very severe recession, with the risk of a depression still very much there if this next stage is not handled correctly. We look at something like the S&P 500 on the chart right now, and it's interesting where we actually stumbled in this rebound rally that we've seen in US stock markets. The stumble came around that 3,000 mark. Now, historically, this has been a very significant area of support and resistance for obvious reasons. The fact that this is a big psychological level often plays a very important role in markets. The fact that on this occasion it also falls around a cluster of important moving averages, as well as the 61.8 fib level, does add additional resistance to this level. Perhaps the fact that we are seeing profit taking around this level is more of a technical move, and maybe traders are just jumping on the back of these Powell comments. We'll have to wait and see how that pans out. But the next couple of weeks will be really interesting as far as the markets are concerned. A lot of the major banana skins that we were expecting over the course of the last couple of months have now passed us by. Earnings season passed by. We saw investors give companies a relative free pass. The data has been dreadful, but again, investors giving it a free pass. This is being recorded just ahead of the jobless claims figure, but given how they've taken that in the past, you wouldn't expect there to be too much of a shock factor. The jobs report, likely to be the worst jobs report I ever see, and many of us ever see, again, given a relative free pass. So all we have to focus on right now is the coronavirus. Our economy is going to open up. How fast are they going to open up? How successful is it going to be? And what about that dreaded second wave that we're already seeing appear in the likes of China, South Korea, and Germany? This is going to be something to watch, because if these second waves are anything like the first, then I would expect investor sentiment to dissipate very quickly, and we could see markets potentially going into free fall again, even with all of this stimulus in the global economy.